Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is May 27th of 2022. We're glad everyone could join us this week. And after 7 straight down weeks, or if you're following the Dow, 8 straight down weeks, the market finally had an up week. And the good news is, I think there's a lot of healthy signs in terms of what this bounce looks like. Now, we're going to get into the details during the presentation, but every single bounce off of a bottom is a bear market rally until the actual evidence and the levels that are crossed come into being. So we're going to go through what those levels are, what the characteristics of the bounce need to look like for us to get more and more confident. We think that there's some good early positive tea leaves to take away from this week. But before we continue to ramble on, let's go ahead and get started. So the title of this week's presentation is "The world is really scary," and it's true. The world is always going to be scary. And for us as investors, we have to learn to burn through these headlines, look through to the fundamentals of the individual companies, and invest in a more boring way. The markets and companies and how cash flows are generated and ultimately converted into rising or falling equity values are not determined by war, are not determined by politics. They're driven by fundamentals, economic and business cycles, technological revolution, disruption, and change. These are the things that ultimately make money or lose money for investors. So this week, we're going to go through the technical backdrop of the market. I think it's really important after we've had 7 straight down weeks. What do we need to see happen to make this rally sustainable? Number 2, is this a bear market rally? All bottoms during a bear market are a bear market rally until we cross those resistance points. Lastly, what are the insiders doing? And before we begin, I do want to leave everyone with this New York Times front page cover from 1987 when, of course, the market dropped 23% in one day. The entire bear market was far deeper than that, and everyone thought it was the beginning of the next Great Depression, right? We look at here, there's 1987 equal 1929. Lots of people sold, lots of people went to cash in order to be prudent, so-called prudent, and then they sat out of the next 13 years in terms of the massive wealth creation cycle that was about to take place. Don't let that happen to you. Don't get distracted by scary headlines or noise, because guess what? There's never going to be a shortage of reasons to sell. And that's what the chart here on the left shows. Over the last 13 years since the global financial crisis, there's been no shortage of reasons to sell. Anything from the global financial crisis, nationalization of the banks, the European debt crisis, the Libyan civil war, fiscal cliff, U.S. debt downgrade, Ebola, the first Ukrainian war between Russia and the Ukraine, Greek default, the potential dissolution of the euro. We go the Fed mistake in 2018, COVID. So it's never going to end. There's always going to be headlines of scare. Sometimes it leads to 1 or 2 weeks of weakness. Sometimes it leads to 4 to 6 months of weakness. We're not going to try and time that. What we're going to try to do is stay focused on companies that are good, getting better, focus on those fundamentals. We're not worried that what everyone else is trying to do. We got to stay focused on secular growth and companies that are good, getting better. Now, real short term here, we can see the number of news articles mentioning bear market have dramatically spiked. This is not what we use to call a bottom, but certainly is a reflection of bearish sentiment in the overall market. In March of 2020, when you saw that giant spike, that just kind of tells us, you know what, a lot of the bad news is baked in. When people are scrambling to look for this word, it just means if you're already looking for the word, you've probably already sold stocks at this point. So the other thing we hear about is the death of growth stocks, right? We're going back into this new renaissance of value leadership. I got news for a lot of people. It really has never really existed. There are value stocks that are cheap that turn their business around and then become growth stocks, and those stocks go up. But low PE stocks don't go up because they have low PEs. They have low PEs for a reason. They're bad businesses. High competition, low margins, low growth. And until that company reinvents itself, it's going to stay that way. A lot of retail companies have stayed that way for many, many years. A lot of staples companies have stayed that way for many, many years. A growth company is quite simply a company that has healthy fundamentals, has done something to reaccelerate growth in terms of earnings, free cash flow, and sales for not just a quarter, but year in, year out over a multi-year time period, and investors reward it. And so you can see here over the last 30 or really 25 years, yes, we've had bouts of value leadership. Whenever this line goes down, that's value leadership. But then the longer term trend has always reverted back to growth over value. And the only time we've really seen this value leadership has been during recessionary scares, 2000, 2008, 2018, a short blip during COVID, and of course, over the last 6 months. But again, the longer term trend is upward and to the right for growth over value. Why? Because investors want growth. That's why you invest in a company. You don't go and buy a restaurant and say, well, I want a restaurant that's not going to make more money next year. You buy a restaurant for the most part because you want to make more money on that investment. So the question is this a bear market rally? Remember what we said at the beginning. All bottoms are bear market rallies until we break out above those resistance points. Right now, we're trading under those moving averages, and we're trading below the last breakdown point. We need to get above those breakdown points to give us increasing confidence that we're dealing with a durable bottom. Yes, this rally has been very healthy, but those points are going to be clear. Those points are going to be key, I should say. Number two, and this is a good point, this is a check mark, the number of advancing stocks relative to declining stocks has been significant. Like in other words, that ratio has been very positive. And when you combine it with advancing stocks that have more volume than declining stocks with declining or with volume, that has been largely positive as well. So upward advancing stocks have had enormous volume. Downward stocks have had less volume. So that's a positive divergence. Number three here, we need to see strong follow through days. So one of the big things that's been really frustrating to a lot of people is we've had these rallies, and then the very next day you get clobbered back down. This is the first time in a while we've had really 3 days in a row of strong follow through, good volume, strong breadth. The only thing that's really been missing, we haven't had an enormous amount of what we call 2 standard deviation upside moves for a vast majority of the issues on the NYSE, in terms of issues being individual stocks. We want to see more of that. That would make us feel even more positive on this overall bounce. One other thing, when we were selling off and the market was declining, you didn't see that huge put call spike that you typically get. In other words, that rush for protection or portfolio insurance. We didn't see that panic. You don't need it. In 2018, when we bottomed in December, we didn't get a huge spike there. We got to elevated levels. We just didn't really get above that 1.3 level that you generally want to see, 1.3, 1.4. Again, not a requirement. So that's something we want to watch. And then lastly, investor sentiment and overall investor positioning has been completely bearish. Bearish levels not seen since the global financial crisis, both from positioning and investor sentiment data. That's good. That's a check mark that we can put off on that box. So everything is kind of aligning. The only thing that really didn't was that put call spike during the sell-off. And we want to see more upside 2 standard deviation moves on some of these strong green days. So when we look at the S&P 500 overall, we've had a nice double bottom right here. You want to see good, healthy double bottoms when we're trying to put in a bottom after a bear market. Number two, we're rallying into this 4,200 resistance point. What makes that resistance? Well, this is where we broke down from the lows of March and late April. So we're rallying into the breakdown point. That's going to cause a lot of congestion. We want to break up through that. That should open the way to challenge some of these moving averages that also will offer resistance. But that's the key. First, rally above the breakdown point of mid-March and late April. Number two, get above these moving averages, and then we're really kind of off to the races after that. Short term, you can see here on the chart on the left, we did break above some of this resistance. That should allow us to challenge that breakdown point. We're also seeing some positive divergences here. So S&P 500, this is the chart here, huge breakdown. We broke the lows in late April, and then we made new lows. But notice what happened. The number of stocks, so advancing versus declining stocks, the number of individual stocks making new lows along with the overall market positively diverged. So fewer stocks are making new lows. That is a sign, typically, not all the time, historically, of a potential durable market bottom. And that is something we definitely look for and want to see. The other big thing that we saw, retail investors started to panic, started to sell, started to buy put options at any price. So you buy put options as insurance against portfolio declines. They're paying any price for it. That's what you want to see. Meanwhile, guess what corporate insiders are doing? So what are the CEOs of S&P 500 companies doing? They're buying stocks like crazy at levels we haven't seen since March of 2020 and in December 2018. Of these two groups, who do we think has better information to determine whether a stock is going to go up or down over the long term? I think I'm going to go with those corporate insiders. So I think this is a very good sign overall. Now, in terms of inflation, we know that's been the boogeyman. Good news here is the PCE data, 2 months in a row now, has started to come down, right? We talked about that inflation peak in March. April, we saw even stronger follow through on that. In addition to that, we're seeing wage data starting to roll over. We're starting to see used car prices roll over. Goods data in general, Target inventories up 40%, Walmart inventories up 20 to 30%. Guess what? They got to clear those inventories out. They got to cut prices and get rid of it. That causes disinflation. That's good. We see the same thing over here with real estate on the left. The number of new listings is spiking up just as mortgage rates have spiked up. That has led to softness in the real estate price market. So again, these are good signs that inflation is starting to roll over. That should take the Federal Reserve off to the sidelines on the back half of the year. They are going to raise rates in June. They are going to raise rates in July, most likely, but you're starting to see signs that the number of rate increases that the market is pricing in is severely declining. Now, the very last thing here, ladies and gentlemen, Chinese stocks. We are very positive on Chinese stocks. We own a few in the portfolio, in the growth portfolio. Why? They're very cheap. They're growing strongly, huge free cash flow machine, and they bottomed in March. The S&P 500 didn't bottom until May. Quietly but surely, a lot of these Chinese tech giants have started to bottom way back in March in a face of against just an entire wall of bad news. When we think of Chinese shutdowns, political turmoil, there's a lot of bad news, and it is a very hated asset class, but they're making those bottoms and higher highs and higher lows, and they're very, very cheap. So bottom line, after a long period of pain, we do believe these growth stocks are starting to bottom. Now, that's not a guarantee that they'll continue, but they have started to bottom over the last week. We want to see that follow through after what's been a healthy week. Follow through days are key. We want volume, we want expanding breadth, and to get past and above some of these resistance points. First key level, get above the breakdown point from late April. The second key levels, get above these moving averages. Again, we want growth over value to be the leadership on this bounce. And then lastly, of course, we do see Chinese stocks making that positive divergence. So thank you, everyone. Have a fantastic Memorial Day long weekend. Thank you to all of our active servicemen and women that are in uniform both today and in the past. We can't live this life in America without all of the services that you've provided. Thank you again. Thank you to everyone and our clients. If you have any questions, please contact your advisor or contact our offices, and have a wonderful, safe, and fun long weekend. Thank you.